Think about waking up tomorrow and finding that half of your money has been lost overnight. Scary, right? The truth is that many people make critical mistakes in investing because they don't understand key financial terms. But what if I told you that knowing just a few simple concepts could protect you from costly errors and help you grow your wealth? Stay tuned as we discover the basic investing terms every investor must know and how understanding them can save you from a financial crisis. Before we dive in, don't forget to hit the subscribe button and click the bell icon so you don't miss any updates from our channel. Let's start off with the foundation of investing stocks. Stocks, also known as shares, are units of ownership in a company. For example, if you buy stocks of HDFC Bank, you become a partial owner of HDFC Bank. Stocks can give you dividends and also certain benefits depending on what types of stocks you own. While stocks give you ownership of a company, owning them does not get you to make decisions in its daily management. Instead, it means you are trusting the company's leaders to handle operations according to their vision. And the most important thing that you should always remember is the price of stocks can rise and fall based on the company's performance and market conditions. Now that you understand what stocks are, let's take a closer look at equity. Equity, also known as shareholder equity, represents the amount of money that would be returned to shareholders of a company if the company sells all its assets and pays off all its debts. In the case of acquisition, it is the value of the company's income minus any debts that are not part of the deal. You can find equity listed on a company's balance sheet, and it helps investors understand how financially healthy a company is. If stocks are the risky part of investing, bonds represent the safer side. Bonds are a type of investment where you are lending money to the government, company, or other organization. In return, they pay you back the full amount, that is, the principal, on a specific date known as maturity date, with the interest at a fixed rate during the life of the bond. You can think when you buy bonds, you are acting as a bank, lending your money with the expectation of getting it back with interest. Bonds are considered to be safe as compared to stocks because they offer more predictable returns. But keep in mind, they generally have lower potential profit. Now, if managing individual stocks or bonds seems overwhelming, mutual funds might be the answer. Mutual funds are investment pools where many people put their money together to invest in a mix of stocks, bonds, or other assets. A professional fund manager manages the money and decides where to invest the money to make it grow instead of you. If the investment does well, your money grows. If they don't, your investment might go down. Mutual funds are popular because they offer a simple way to diversify your investments, meaning your money is spread across many different things, reducing risk. Within mutual funds, there's a special type that mirrors the overall market, which is known as index funds. As the name suggests, index funds are a type of mutual fund that replicates the performance of a particular market index, like the Nifty 50 or S&P 500. Instead of picking individual stocks, an index fund buys all stocks in the index it follows in the same proportion. For example, if you invest in an index fund that follows Nifty 50, your money is automatically spread across all 50 companies in that index. If the market goes up, your investment will go up too. And if the market goes down, your investment might decrease. Beyond stocks and bonds, the world of commodities offer another avenue for investment. Commodities are basic goods that can be bought, sold, or traded like gold, oil, wheat, or coffee. And they are traded based on their current market prices. For example, when you trade commodities like oil or gold, you are not dealing with the actual physical product. Instead, you are trading contracts that represent a certain amount of commodity so that you can buy when the price is low and sell when it goes up to make a profit. Commodities are different from stocks and bonds because their price can change due to weather, politics, or changes in supply and demand. Now let's dive into more advanced territory with futures and options. Futures and options are types of financial contracts used in trading that allow people to buy and sell assets like stocks or commodities at a set price in future. Futures are agreements to buy or sell an asset at a specific price on a specific future date. When you enter a future contract, you are obligated to complete the transaction when the contract expires. regardless of the market price at that time. For example, if you agree to buy gold at a certain price 3 months from now, you must do so even if the price of gold has changed. Options give you the right but not the obligation to buy or sell an asset at a specific price before a certain date. There are two types of options. The call option gives you the right to buy an asset at a set price. A put option gives you the right to sell an asset at a set price. With options, you can choose not to go through with the transaction if it's not profitable. In simple terms, futures lock you into a deal, while options give you a choice to make a deal if it benefits you. If you're looking for regular income from your investments, dividends might be what you need. Dividends are payments made by a publicly listed company to its shareholders, usually as a reward to shareholders for their investments and to attract more investors. When a company makes a profit, it can choose to either reinvest that money back into the business or share some of it with its shareholders in the form of dividends. Now you must be thinking, how much an investor can expect to earn in dividends? Well, it depends on a few different factors, including how many shares you own, the company you've invested in, and how often they decide to pay dividends. For example, if you own shares of a company paying 10 rupees dividend per share, you'll receive money based on the number of shares you own. Risk management in investing involves understanding and managing the level of risk you're comfortable with to navigate market uncertainties. This includes assessing your risk tolerance, which depends on factors like financial situation, investment goals, time horizon, and comfort with potential losses. A key strategy in risk management is diversification, which spreads investment across various asset classes and industries to balance risk. Investors must weigh the risk-reward trade-off, recognizing that high-risk investments offer the potential for higher returns but also greater losses, while low-risk investments provide stability with lower returns. Tools such as stop-loss orders, hedging strategies, and asset allocation help manage risk by limiting losses and strategically distributing investments. Ultimately, effective risk management is about protecting your portfolio from significant losses while still pursuing growth. Finally, let's talk about inflation. Inflation is the gradual increase in the prices of goods and services over time, which erodes your purchasing power and reduces the real value of your money. As inflation rises, the same amount of money buys fewer goods, meaning your investments must grow at least as fast as inflation to maintain their value. This is particularly important for fixed income investments like bonds, where a fixed interest rate can lead to a loss in purchasing power if inflation exceeds the interest rate. To combat inflation, investors often include assets like stocks, real estate, or inflation-protected securities, such as TIPS, as these have the potential to outpace inflation over the long term. Strategic investment planning should always consider inflation, incorporating assets that can hedge against its effects, and adjusting based on economic indicators that signal inflation trends. So there you have it, the top 10 investment terms you need to know. Understanding these basics can help you make smarter investment choices and feel more confident in your financial decisions. If you learned something through this video, don't forget to like, subscribe, and hit the bell icon for more content like this. Thanks for watching and see you next time.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.